Bitcoin has been moving up relative to gold. That's interesting. And then just the last two or three charts here. This one is still a puzzle. Why is that green line, metals to gold, still going down? Is it China? Is something really wrong in China? I don't know if it's just China, but it is puzzling, especially now that the gold price has gone down from nearly, I think it was almost.
If the biggest opportunity in the market isn't hiding in the usual places. While most investors are distracted by headlines about inflation, interest rates, and global uncertainty, a completely different kind of revolution is quietly accelerating. What if the next wave of wealth isn't built on traditional industries, but on technologies that are reshaping the world as we know it? That's exactly the vision being championed by Cathie Wood. While many remain focused on short-term volatility, Wood is looking far beyond the noise. She sees a powerful convergence of innovation, artificial intelligence, robotics, blockchain, and genomics driving exponential growth across industries. In her view, we're not heading into a period of decline, but into one of the most transformative economic shifts in history. And for those who understand it early, the upside could be massive. If you find value in this content, please take a moment to like the video, subscribe to the channel, and turn on post notifications for more videos like this.
We're seeing the S&P to gold, and we've been watching this carefully. Remember, it was a leading indicator for some very bad times in the 70s. And there are some strategists out there who think we're going back into those bad times. We do not, but this is uncomfortable in that it has tipped down. This is the offset to some extent until very recently. It's crude oil, S&P to crude oil. And that uptrend is still in place, even with the really near more than 50% increase in oil prices. Here's Bitcoin to gold. Bitcoin is starting to outperform gold again. Gold peaked January 28th, the day that Warsh was announced as the next Fed chairman, if Congress approves him. And he is slightly hawkish. So Bitcoin has been moving up relative to gold. That's interesting. And then just the last two or three charts here. This one is still a puzzle. Why is that green line, metals to gold, still going down? Is it China? Is something really wrong in China? I don't know if it's just China. But it is puzzling, especially now that the gold price has gone down from nearly, I think it was almost, was it $5,600 down to $4,400. We haven't seen a clear turn in this variable, which is quite interesting. It used to correlate very well with the 10-year Treasury yield, which you see in purple there. They parted ways in 22 when the Fed started tightening, and I would say when central banks started buying gold and selling dollars. And again, the yen carry trade unwinding starting in the summer of 24. So all of those should be in there now, and my guess is that the 10-year Treasury yield is probably going to fall because we've had a lot of major forces pushing it up, not the least of which has been the recent flare-up in commodity prices. If we're right and the supply side of the economy is coming to the rescue, we're probably going to be surprised at interest rates coming down as opposed to going up. We are just below 99. So what Cathie is suggesting is the people who are willing to trade or make a prediction, they actually think the dollar is going to go up. And that goes against conventional wisdom. Now, we agree that it is going to go up. mostly because of what I just mentioned about foreign direct investment and our capital-friendly, business-friendly tax policies, also deregulation, is, we think, going to increase the return on investment in the United States relative to that in the rest of the world. That is dollar positive. And we take this chart all the way back into the early 80s. Why? It is because we like to illustrate what happened during Reaganomics, and we think Trumponomics resembles greatly, actually, Reaganomics. And look what happened to the dollar back then. Now, it was coming from the depths of despair in the late 70s, but it really went into overdrive to the point where all the Treasury and monetary ministers around the world got together and said, this is becoming a deflationary risk to the rest of the world, because a lot of debt is denominated, was and still is denominated in dollars. So the debt service was getting more and more expensive back then. We think we're not going to see a surge like we did in the early 80s, but we think the pressure is to the upside. And if you look at this chart in the context of history, you will see that we are closer, if you take out that boom in the early 80s, we're closer to the higher end of the dollar's range than we are to the lower end. And again, I think that goes against conventional thinking right now.
Let's now delve more into her thoughts. Cathie Wood focuses on the connection between inflation and the money supply. The money supply is currently expanding at a rate of about 5%, which has historically supported consistent economic expansion without leading to uncontrollably high inflation. However, the velocity of money, basically, the speed at which money flows through the economy, is another factor that most people ignore, and that pace has been declining for decades. Wood points to a few major trends. Aging populations, especially retiring baby boomers, tend to spend less. At the same time, globalization and outsourcing have reduced domestic economic activity. Both of these factors slow down how often money changes hands. Please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this.
Here we're moving into monetary policy and away from fiscal policy. And you can see money growth is up to roughly 5%, so it has continued to accelerate it, having spent some time in negative territory after the uncontrolled money growth post-COVID. You can see that is mapped in green against the CPI. And this is important. It's setting us up for another Kalshi chart. And you can see that there is a loose connection between these two metrics. Part of the reason there's a loose connection is velocity. Sometimes when the velocity of money moves down, that takes the stimulus out of money growth because the rate at which money is turning is slowing down. And that typically happens when people are afraid, concerned, or feeling somewhat negative about their circumstances. So you can see here that velocity actually has been in a downtrend since the late 90s. And that is when baby boomers started to retire. Those were the very early baby boomers, but also it was around the time that China entered the WTO, and there was a lot of concern in the United States. Our manufacturing sector effectively was exported to China, and so there were concerns, and I think those two variables cause the secular decline. Well, baby boomers are still retiring, and again, when they retire, they're not as free spending, and we are now seeing, however, the reversal of the shipment of our manufacturing sector over to China. And I think our tax package is one reason for that. So maybe we're seeing a secular turn in velocity. If not, it will probably flatline here. And because baby boomers are retiring, but the manufacturing is coming back and other kinds of investment coming back, maybe we flatline here, and that 5% money growth is what is impacting directly the economy. And if you think about 5% money growth, that would effectively mean nominal GDP growth would be around 5%. And that would give us room. We think real growth, thanks to productivity, is going to accelerate into the 3, 4, 5% range. That would leave very little room for inflation. So here's another look at monetary policy from a very short-term point of view, meaning it's the yield curve as measured by the 2-year Treasury yield minus the 3-month Treasury yield. And in negative territory, that would suggest the Fed was leaning, I would say, hawkish or restrictive. And you can see we've just crossed into a positive slope, just crossed. So maybe the Fed is operating at a neutral rate. It's not too hawkish. It's not too dovish. We're in a neutral zone right now. And this chart I've featured a number of times. I find it fascinating. This is the yield curve again, but it's the 10-year Treasury yield minus the 2-year Treasury yield. And this is the one most commonly referenced. And you can see the downtrend that's been in place really since the 08-09 debacle, the global financial crisis. And the reason I'm interested is even after COVID, when monetary authorities around the world were, put the accelerator to the floor, and fiscal policy was profligate. I mean, just money thrown at the problem around the world. We couldn't get this measure of the yield curve back into that 200 to 300 basis point range. And I just have been wondering, what does that mean? Effectively, it means that the long-term Treasury yield was not following short rates the way it normally does. And why would that be? And here again, have we hit another peak and are we tipping over again? I don't know. But what that would tell us, and of course, consider the source, it would fit in with our sort of deflationary undercurrent thesis around technology. And we saw this in the 50 years that ended in the late 20s, late 20s in the 1900s, which was also ripe with innovation. So telephone, electricity, internal combustion engine, all riding on top of the railroads that were built out in the 1800s. Well, the equivalent to the railroads this time is the internet in the digital world, and now we have robotics, energy storage, AI, very importantly AI, blockchain technology, and multiomics technology. All of those are highly deflationary trends. And could the yield curve be picking up on that? We think it might. Now here's productivity, which is a part of that story. The technology, the innovation platforms that I just mentioned involve 15 different technologies. They're converging, and we think that productivity growth is going to soar in the next few years.
Cathie Wood is explaining that when you look at monetary policy more closely, the economy may actually be in a stronger position than many people think. Right now, money supply is growing at around 5%, which is typically a healthy level that supports steady growth without creating high inflation. But she says that's only part of the story. The bigger factor is the velocity of money, how quickly money is being spent across the economy. When people feel uncertain or cautious, they hold on to cash, and that slows everything down. She points out that this slowdown in velocity has been happening for decades, mainly because of two things: aging populations like retiring baby boomers who spend less, and globalization, especially after China joined the World Trade Organization, which shifted jobs and manufacturing overseas. Both of these reduced economic activity over time. However, she believes we may be starting to see a shift. Manufacturing is gradually coming back to the US, and investment is picking up again. If that continues, the decline in velocity could stop or stabilize. Her main message is that if money growth stays around 5% and productivity improves thanks to new technologies, the economy could grow at a solid pace without triggering high inflation. In other words, strong growth and low inflation can happen at the same time, and innovation is the key reason why. Please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this.